Initial Public Offering (IPO). When a private company grows to a certain size, it may consider going public by issuing ordinary shares to the public through an IPO. This is so that the company can obtain more funds for financing its business operations and ventures. However, going public has its own disadvantages. Public listed firms are subject to stricter disclosure and other regulatory requirements. How do investors benefit from an IPO? In the 1990s, IPOs achieved remarkable gains in their debut on Bursa Malaysia. Those companies that underwent listing received overwhelming response from the public, with oversubscription rate at more than 100 times. This phenomenon is now replaced by the current and more realistic, mature market, with investors being very selective in their choices. The recent IPOs have shown that many even fell below the initial price on their first days. Before you subscribe to an IPO, make sure you read its prospectus, which discloses the following information: the history and nature of the business, earnings performance, and various accounting ratios such as earnings per share, net tangible assets, debt-equity ratio, and so on. And lastly, the size of the issue. Usually, the larger the number of shares issued, the less likely for the IPO to fetch a higher price on the first day. To get a glimpse at the outlook of the IPO, try looking out for analyst reports in the newspapers and on local financial portals. Additionally, try not to put emphasis on the short-term gain. Instead, hold a longer perspective in terms of potential growth for the new public listed company. With this in mind, you'll be able to make investment decisions based on the company's fundamentals, not on rumors.